Hey guys, Toby Mathis here, and I'm joined by Neal Bawa, a guest that I've had on a couple times a year at least, because he's one of the most knowledgeable people that I know on the numbers involving real estate, having been involved for decades and being one of the more successful syndicators out there and a builder and yada yada. He's really good at what he does. And so I wanted to bring him on to talk about end of year forecast for the market because depending on where you look, it's doom and gloom all over the place, or they're going to lower interest rates and we're off to the races. Neal, what's the truth?
Well, the truth is nuanced, and uh, I prefer to give it to you by giving you what I think are the three or four most important numbers that are easy to understand, right? So, and I think I'll take those numbers and sort of give you my view of where I think the housing market's going to go over the next 2 years, because we are in a very, very cool and interesting time going forward for the next 2 years. And a lot of the things that are going to happen are locked in, meaning, if you don't get a COVID type black swan event, we actually have a good feeling of what is going to happen for the next 24 months because all the parameters are locked down. So this is a really, really good time to be having a data driven conversation, a fantastic time, in fact. So we're 4 years from the start of COVID, 4 years and a couple months, right? In that time frame, the average mortgage in the United States is up 111%. So if you were getting a mortgage one day before COVID and you're getting a mortgage today, well, that mortgage is now, the average mortgage is up, or the median mortgage is up 111%. But over that time frame, Toby, salaries in the United States are up 19.6%, right? So you've got salaries that have gone up only 20%, and you've got the average, mortgage that's gone up 111%. And that gap is ridiculous and is the largest in history for anything under 10 years.
That's that's affordability, right? That's affordability. Like the cost of the mortgage, not the size of it. Like the cost of that mortgage is up 100 and wow.
111%. And it's up for because of two factors. Home prices are up 46% since COVID. So in that same 4.25 years, home prices are up roughly 10% a year, right? They're slowing now, but remember there was a time in 2021 when home prices were going up 15, 16% a year. So the average is about, 11% a year. So we're up 44%, but the majority of that 111% has actually come from interest rates which have effectively doubled, right? So the vast majority of that hit to that mortgage payment has come from the fact that everyone's paying a lot more interest now, and that affects your mortgage payment. And so how is it that Americans can only make 19.6% more, but qualify for a mortgage that's 111% higher, right? And because of this, more and more people are using the word that I like to use and I've been using for the next 3 years. An entire generation of Americans, roughly 18 million families, and they're younger. These are families with people that are under 45 years, that would have been homeowners in the United States before COVID. So one day before COVID, this group of 18 million would have at some point over the last 4 years or over the next 4 years become homeowners because they would be able to afford that old, small starter home, that are now forever renters. Forever renters. 18 million families are priced out, right? And we'll talk about the fact that home prices are not going to crash and why they are going to continue to be priced out, but I'll give you those numbers later. Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts,
but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content.
And so all of a sudden, the United States goes from being a nation that roughly 2/3 of the people live in their homes and 1/3 become renters, all right? It's 2/3, 1/3. And the home ownership rate is taking a beating, absolute beating, right? Because of this largest ever gap in 4 years, which is, as you said correctly, the affordability gap, right? And so it has created a ridiculously large opportunity for landlords. And some of the opportunity, just so you know, is not a apartment opportunity, because a lot of these are actually families with 2 kids and 2 dogs and a cat. And they actually either want to live in rental townhomes or rental single family homes as opposed to living in apartments. But the opportunity for apartments is also pretty strong. And so this year, as an example, this is the peak year of supply for multifamily, right? Multifamily, usually the supply tends to be 300 to 400,000 brand new apartments a year. That's sort of a normal number. This year, we're going to deliver 673,000 apartments, which is last time that happened, the president was Nixon, right?
So it's a huge amount. Like that
That
seems
is a
like
massive amount, right? And you would expect that the apartment market would crash.
crash. Right.
But
You think
Toby, rents in the United States are positive, with the largest incoming supply since the 70s, showing just how much demand there is for apartments. And there is an absolute 100% locked in guarantee at this point that next year's supply will be much lower than this year, and 2026's supply will be much lower than that number, because I'm counting how many permits are starting, and because of interest rates, developers are starting less than half of those that count, that 673, are being started last year and this year. So we know that there'll be a massive shortage in 2026. And that's why there's this, our next 2 years are already locked in, because if developers don't start today, they can't finish in 2026, because it takes 2.5 years to build apartments, right? Nobody can build them any faster.
so. Let's unpack that real quick, because I want to make sure everybody's following. What you're saying is that this year we needed to deliver 500,000 or so units. We're over that. We're over 600, 700,000 units, right? But there's arguably a 5 million unit shortfall already, right? There's this idea that we've been underbuilt for the last 10 years. Depending on who you listen to, it's 3 million, it's 5 million, it's 4 million, it's 2 million. There's a huge number that we were underbuilt as it is.
Mm-hmm.
And what you're saying is that in a year, that's going to be exacerbated because there's not enough housing starts, and it takes a long time to permit and get building and get moving on an apartment complex. We're not going to have enough units in a year. We're only going to deliver what's the number?
So at this point, we're forecasted to only deliver 230,000 units in 2026. So we're midway through 2024. 25 is that in-between year. 26 is the make awesome money year, because 230,000 units, Toby, is absolutely unacceptable. And remember this, for every 10,000 units that you're short, rent growth spikes. And we're going to be about 150,000 units short in 2026, which is why I'm going to make a prediction, and this will be egg on my face if I don't get it right. 2026 rent growth in the United States will be double digit.
What about interest rates dropping, affordability increasing? Because one of the things is it's the interest rates that went up. That's what caused mortgages to be unaffordable. On the same token, the amount of equity that people are sitting on, I saw it went from like 120 to 200,000. Like, people are sitting on a lot of equity in their homes. This is not 2008 for all those people. Gosh, I mean, you and I sat here a couple of years ago and we're talking about this, and here we are. Everybody's screaming, "This is going to be a crash." It's 2008. It's like, no, nobody's underwater on these properties. They're sitting on
I think people fundamentally don't understand just how much equity homeowners have built. And the equity has been built because we've had 10 years of extremely low interest rates, where people have basically financed their homes, then refinanced, then refinanced. Like, When I bought my home in 2005, my interest rate was 8.25. Then
Oof.
3 years later, it was 5.25. And
Mhm.
then it was 3.25 in 2014. And I'm currently at 1.75% 15-year fixed, right?
Holy cow.
So 2005, 8, 14, and 9 and 2020 are my refinance years. And so by each time I didn't suck out equity. I just basically went to a lower payment, and that allowed me to make more money. And in the same 15 years, the value of my home has gone up by about $1.8 million. So other people, the dollar numbers may be different, but I think the increases are representative of my story, right? So equity matters a great deal, right?
Mhm.
A crisis happens like it did in 2005 because home prices in certain markets like Phoenix and in Florida went down 60 to 70%.
Right.
But today, the chances of that happening are extraordinarily small. Firstly, because those homes belong to people that actually have the income to support them. In 2005, we were basically doing sight unseen loans with stated income. None of those things have happened in the last 10 years. It's actually hard. It's hard
Yeah.
to qualify for loans. And we have very good underwriting mechanisms. So I am not seeing homes going to people that can't afford them. And if anything, because of interest rates being lower and lower and lower, all the way down to that 1.75 ridiculous number that I locked in, that homeowners actually, their payments are pretty small, right? So they actually have the ability, if they, for whatever reason, stop getting renters, something bad happens, they stop getting renters, they can just keep paying because their payments are small. So comparing this to 2008 absolutely makes no sense because the people that are owning it are rich investors, right? Rich investors are the ones owning the rental homes.
And they're buying them cash. I think it's
Yep,
1 out of 3 or some. Like I'm in Vegas, and it's
33% roughly. Yeah.
they keep showing the stats. It's like, and I'm part of the problem, right? Because I'm a addict to
You're a
buying.
cash buyer. Shame on you.
I'm,
Um,
I can't I hate debt. Just but anyway, going on now. Let's talk about debt, because if they lower the interest rates, then what's going to happen? Because they're going to lower the interest rates. It's just a matter. It's a matter of time. It's not if they are going to lower interest rates.
it is a when, right? So let me start out by saying this. PCE is the Fed's popular measure of inflation, PCE, right?
Mhm.
PCE was peaked at 9.2% in July 2022, um, July 2022. And since then, it has been on a pretty much a continuous downward curve um, on a quarterly basis. Sometimes on a monthly basis, it'll pick up. And the latest PCE print is 2.7%.
Oof.
And the Fed would ideally like it to be 2. The Fed doesn't want inflation at 1%. It doesn't like low
What do
inflation.
they flick? Do they just take these numbers out of the air? Do they just like, yeah, we want it to be 2%? Like, where do they
Right.
get?
It's a desired number. If you look at the years before COVID, maybe only about 5% of the time in the last decade did the Fed actually get the rate to 2%. Inflation was always a little lower than 2 or a little higher than 2. So they're looking for a band, right? And that band, really, the best way to describe it is 1.5 to 2.5%. If there's there, then the Fed's pretty happy. We're 0.2% away from that band with the latest inflation print. So the Fed is simply saying the economy is so strong that I can take my time to make sure that I don't make a mistake, because we all blamed the Fed for making the mistake of raising rates too late. And so what the Fed doesn't want is, we'll take the risk of there being a potential short recession. We'll take that risk. What we don't want is you guys come back to us and say, see, again, you cut rates too quickly. You raise them late and you cut them too quickly. They don't want that blame game. So they're saying, we'll take our time. But if you look at the Fed dot plot, there was a Fed meeting a few weeks ago. The Fed dot plot hasn't changed. The Fed is still saying we're going to get rates down. The only thing that's changed is the Fed said, hey, we took an extra 6 months because in the spring, the US economy was strong. So we took an extra 6 months. But otherwise, compare the Fed dot plot from 2 weeks ago and the Fed dot plot from 2 years ago. They're the same. All that's happened is it's taken us 6 to 7 months longer to get to that rate cutting point. And now the 65% chance of a rate cut in September, almost 100% chance of a rate cut in November. So Fed meets in September and November. And the Fed has now upgraded, right? They're now saying 4 rate cuts last year, where if you looked at the dot plot 3 months ago, they said 3 rate cuts next year. Now they're saying 4. The dot
They
plot's
pushed it
changed.
forward.
They've pushed it forward. So they're now saying we just pushed them into 2024 because we got less than what we wanted in 2023. So you're right. It's a question of when, and we're there. We're finally there because inflation's at the point where the Fed is going to reduce rates. Now, I want to point out that the Fed desperately wants to reduce rates because what the United States is playing on its debt right now is absolutely, catastrophic, right? And there's just no need. Just so you know, a 5.5% Fed funds rate, where we are right now, does not in any way equate to 2.7% inflation. So this is a window of time. It is an unusual time. A 2.5% inflation equates to a 2.5% or 3.5% Fed rate. So it's got to come down by 200 basis points, where it'll probably take 18 months to get there. So what we predict is 18 months from now, barring another black swan event, rates are going to be 1.5% lower. They might be 2% lower, but we'll just use 1.5% lower. Now, what happens when the rates are 1.5% lower? Affordability goes up, because remember that thing I said, American incomes are up 19.5%, but their mortgage is up 111%. Well, as a result, what happens is that mortgage drops. So that gap starts to drop from 111, it drops to 100, drops to 90, drops to 80. And it's roughly at 80, right? If mortgages go down by 1.5%. But once again, your income went up 20%.
And it's still going up.
Affordability is still at 80. So you still have a massive number of people that are renters. So the renter pool is not affected in any negative way by this. But what it does do is, because home prices are now more affordable because interest rates are down 1.5%, it puts a ceiling under home prices. How can home prices go down when more people are available to buy homes? When more people have the ability to buy homes, home prices go up, or at the most they're stable. So this concept of home prices are about to crash, there was actually some value to saying that 2 years ago, because rates were on the way up. When rates are on the way up, you can say, hey, people may not be able to afford homes, so they'll go down in value. Why would home prices go down when rates are going down? That makes no sense. There's actually no known time since World War II when declining rates have seen home prices go down at the same time. It just simply is not something that happens.
Yeah, and I guess the argument would be there's a lot of people that would have sold their homes, but they're stuck in these low interest mortgages. And so it's not like they can move it to a new property. So they're stuck. If they could, they'd sell. Yes. And at some point they're going to sell, and then you're going to have all these people, and you're going to have this inventory start hitting the market. Bloosh. That would be the argument, saying, hey, that's going to have a downward push on pricing.
Let's discuss that, because I hear that all the time, right? So here's what happens. Let's assume there's 1 million people right now that are waiting, and these people are locked in very low interest loans, right? So maybe 3%, 4%. And they're like, okay, well, now I'm ready to sell. And they put their homes on the market. And because 1 million homes suddenly come onto the market drops 5 or 6%. Well, here's what'll happen. This is not 2008. Remember, these homes have huge amounts of equity. Half of those homes are going to get yanked off the market because people are like, no, I thought I was going to get 600,000. Now I'm only getting 570. I'll wait because I'm at a 3.5% interest rate and I can afford to wait. The moment that those get yanked, the market stabilizes. So now you have a ziggy-zaggy movement, right? Prices go down, people pull homes off, prices go back up, ziggy-zaggy, right? That's what happens. There is no urgency for these people to sell their homes. If they don't get the price that they want, they'll yank prices off. That puts a glass, bottom under prices.
What about the tenants? There's a lot of people that would have bought a home had they been more affordable. Are those people are going to be jumping into home ownership? Are we going to see a push where all of a sudden folks that have been on the sidelines, and rents have been going up? Like, I know you're in the multifamily deal. I'm mostly single family, but rents have been going up. Everything's really expensive. In Vegas, it's stupid. 1 bedroom. Yeah, a condo is $1,600 or $1,300 to $1,600 a month. It's bonkers, right? So those people are going to want to buy a house, or they're going to want to buy a condo.
Yes, and the honest answer is absolutely, we will see more people move over. But please understand that this new group of forever renters that we've created are 18 million people. And with a 1.5% decrease in rates, you're going to get about roughly 3 million out of those people to say, now I qualify. they're
Yeah.
not qualifying right now. So we'll have about 2 to 3 million of those people move over. But this unsaturated demand, all that means is we've gone from 18 million forever renters to 15 million. So the market still stays in balance, but yes, there's going to be a little spurt of those people when rates go down about 100, 125, 150 basis points. But at the same time, now investors return to the market. So please understand, the key factor is investors are sitting on the sideline because the math doesn't work. Investors need the same 150 basis point to get back into the market, right? So now you have investor demand picking up, right? And they're making homes more expensive, and that by raising prices, they're now preventing more people from jumping into home ownership because there's two sides that are yanking against each other.
So let's talk about this for 2024. So we're sitting here midway as we're recording this. We're a little bit more than halfway through the year. What's going to happen before the end of the year? Is this something where investors should be sitting and waiting? Is this something where they should be taking action now? And what are you doing right now? I guess I just gave you a 3-part question.
I'll just answer the question from my perspective, right? I'm a single family investor, a multifamily investor, and a land investor. So I'm just going to cover those 3, and I'll explain my strategies, and you take what you get from that. On the single family side, I'm a net seller. So what I'm doing at this point in time is I'm saying over the next 6 months, I need to see 1 or 2 rate cuts. That'll actually temporarily juice the prices, because what'll happen first is, affordability will increase, and a bunch of people that are sitting on the sidelines will come in. They'll want to buy. I want to sell my homes to them, right? And then after a while, what'll happen is, more homes will come into the market and the price will equal out. So I'll have an opportunity to basically be a net seller for my single family homes in the next 6 to 12 months. I don't perceive single family prices going up or down in the next 12 months. I think they stay the same, because remember, there's forces yanking. Prices can go up because rates are going down. Prices can come down, because there's less tenants needed because they're sort of jumping over to the home buyer side. So both sides, you have a little up, a little down. So I don't see home prices moving a lot in any market in the United States. They're sort of plateaued right now. In the last year, the highest that I've seen home prices increase is one market with 6.5%, and the lowest was -2%. So it's been a really pretty thin band, with 4% being about the average. Even expensive markets like the San Francisco Bay Area, I live in the most expensive market in the US. Our market, San Francisco, has not lost value, even though the average home price is over 1.5 million. Ironically, it's gained 2%, right? So keep in mind that even in very expensive markets, we are not seeing this effect of nobody can afford homes, so prices are going down. Well, San Francisco, Boston, take a look at the expensive markets and see if that premise is actually supported by data, because it really isn't, right? So I don't see much happening there. The multifamily market is really interesting because here's another piece of statistic. Remember that gap between 19.5% in incomes and 111 in mortgage, right?
Mhm.
Guess how much rents have increased? Home prices, so incomes have gone up 19.6% in the last 4 years. Rents have gone up 19.6% in America. Balance, extreme balance. Multifamily prices are down 25% because multifamily prices are actually based on interest rates through a mechanism called cap rates. So interest rates go up, multifamily prices go down. Single family prices are not down in the last 2 years at all. In fact, they're up a little. Multifamily prices are down 25%. I'm buying multifamily simply because it's cheap. It's cheap. Now you might say, yes, but interest rates are high, right? So the answer is yes, but there's in the commercial world, there's something called assumption. Assumptions are wonderful, right? So why am I getting a 25% discount? Because interest rates are high. So guess what I do? I compensate my team double on finding those loans that I can assume a low interest rate from 2022. So I get the 2022 low interest rate and the 2024 low price. So I'm getting a 25% discount, but I'm still getting a mortgage that's 4%, right? That's a wonderful thing. So the multifamily market is actually an interesting one right now. And often I say the opposite. Often I say the single family market's more interesting than multifamily, but right now multifamily is cheap. The best market is land. And I'll tell you, I mean, I'm super excited about what I'm doing with land. So what I'm doing is, and these are actual numbers, I have a team of 5 people, all focused on this activity. In the last 12 months, We have processed 4,100 parcels, underwritten about 400, made roughly 150 offers. We've got 30 that are in the hopper, and we've got 8 in contract. These 8 properties, I haven't paid for them, right? So these 8 properties are worth roughly $16 million, $2 million per piece of land, roughly, right?
Mhm.
But I haven't paid 2 million bucks. You know what I've managed to do? Because land becomes illiquid when interest rates go up, right? It's just completely illiquid. Nobody can sell land at any reasonable price. My offers for these 8 pieces of land are that I have 21 months to close on them, right? Six months of initial sort of due diligence, 12 months to get permits, and 3 months to get extensions. And guess what I'm putting down for that $16 million? I've only put down 2% of that. So I've only put down 320,000, and I have this 60 land that right now is, I'm paying 16 million for, and that's probably 40% down from 2 years ago because of interest rates. But what I'm doing is I'm zoning and entitling it. And once I'm done zoning and entitling, in 18 months, when we get to the point where every headline reads, we're going to have a shortage of apartments because we didn't build enough in 2023, 24, and 25, when those headlines appear, I'm going to sell them without building them, just entitled, zoned, permitted, for 32 million.
You could, can somebody buy your contract to close if you haven't already closed?
Absolutely. All of them are contracts that I can sell. So I don't actually intend. So my total investment, just so you know, is 2% of 16 million. So that's about 320,000. And I'm spending roughly on these 8 parcels of land, about $1 million for zoning, entitlement, permitting. So I'm in for 1.1 million, and I'll sell them for 32 million. That's opportunity. That
Yeah.
kind of arbitrage is impossible to achieve during normal times, only happens when interest rates are bizarre.
And so you're tying them up, giving yourself enough time where that interest rates will come down. Because the people that are getting beat up in the multifamily, the folks that are having their loans reset, they're being stuck with these high interest rates that cash
That's correct.
flowed and they were making some money, and then their interest rate is going to reset and it's going to be 3% higher. And all of a sudden they're losing money every month. And then
That's right.
they're forced to sell. Or they just can't complete a project. They run out of capital and they can't get any. Right. So there's a ton of those. And you're kind of looking at those going, nah, you're
They'll
looking
stay
at,
out of it.
yeah, there's a lot. You know what? There's distressed market funds. I know a few, and I've invested in a couple where they're really good at going and taking over those deals. And they get better interest rates, especially if they're private equity and things like
Yeah.
that. They have their own money. For us, normal human beings, right? This sounds interesting. So you're going and tying up land that's going to be a multifamily project. You're doing the steps and spending the money now. So this isn't a cash flow. This isn't going to bring you money. This is outflow completely. But it's a very strategic outflow where you're saying within 20 months, interest rates are going to be lower. The people that are going to want this is going to be really high. You're watching the building permit saying there's going to be strong demand. And
Yeah, in 2026, people are
yeah,
like, interest rates are down, math works. I haven't done anything for the last year and a half or 2 years because interest rates haven't allowed me. How can I build 150 units right now with my staff? These are developers. And they're like, Neal Bawa has this permitted property that's for sale on CBRE or LoopNet or whatever. I'll just buy this because tomorrow I can
I
be
can do
breaking ground,
Yep.
right?
I get you 100%. It's almost like flipping because, it's one of those weird things where, like, right now, I would not be a flipper. Actually, I would never be a flipper. I just suck at
I
it.
don't ever want to be a flipper, but right now is a terrible time to be a
Yeah.
flipper.
Because, it's always like time's not your friend, usually. In this case, you've turned the tables, time's your friend.
It
That's
works
really interesting.
beautifully for me, right? And what's cool is that now that we're in contract and the market hasn't yet switched, even within the contracts, we are going back and negotiating with people saying, hey, remember that first 6 month period before our deposit goes hard? We need another 3 months. We'll give you a 1% increase in price. So I just negotiated a piece of land in Liberty, Missouri, which, by the way, I'm paying nothing for. So it's an $800,000 piece of land, but that I can build 100 townhomes off. It's opposite the Liberty Hospital, and the hospital is paying the $800,000. I'm not giving them any equity. I'm not giving them any money. It's just free contribution so that I can build 100 townhomes. I give priority to their staff. So my initial cost is anyway zero, but I haven't spent that 800,000 yet because I'm putting down 2%. And now that 6 months have passed, I have another 15 months remaining, but I'm saying, going back to them and saying, can I increase this price from 800,000 to 810? You give me another 3 months? And the answer is yes. Why? Because land is still illiquid. So I'm
Yeah.
even buying myself another 3 months for $10,000, 21 months in the future, which I don't really care about because I'm going to be selling that land for 6 or 7 million.
All right. So I'm going to try to condense this. So at the end of the year, we don't see a crash. We do have a lot of inventory, so you're going to see kind of stability in pricing. When
Rent
interest
prices.
rates start when interest rates start dropping, we could see some price movement. It might be sporadic. It might be a little bit down, a little bit up. Probably not a good time to be a flipper, but could be a great time to be a long term. I'm going to call it, instead of flipping, I'm going to call it skipping. I'm going to coin a new term. You're going to skip forward a couple years. You're going to tie up a property for a year to 2 years so that the interest rates, when they start to go down, the value goes up. I mean,
Yeah.
it's still a risk, but
I,
that
I
seems
do
pretty
want to
silly.
give people who are in the 1 to 4 units a tip. This
Mhm.
is, let's say you're somebody who's comfortable with duplexes, maybe you've done a fourplex. I want to encourage you to do a 5 unit, and I'll tell you why. Okay, this is very, very important to understand. 1 unit is single family, but the way loans work, 2, 3, and 4 units are also single family.
Yep.
Prices have not gone down for any of those. Why? Because the single family market is on an upward price trend, slow but upward. Now, the moment you switch from 4 units to five, something magical happens. 5 units, the loans and the prices are based on interest rates, where 1 to 4, they're based on sentiment and comps, right? So if you go up 1 unit from 4 units to five, you'll notice the prices there are 20-25% lower. So I encourage you to look at 5 units that you buy today with 25% decline in prices,
Mhm.
and try to look for people that have assumable loans, because on the commercial side, you can assume those loans. So find a loan that's at 4.5 or 5%, buy the property at 25, maybe 20% off, and
Mhm.
you are gold. That is the best acquisition opportunity available today, and you don't have to go higher than 5 units.
Yeah. And I would say this, I'm a cash flow guy.
Mhm.
There's still cash flow opportunities out there.
Absolutely,
And
especially if you're assuming a loan and that loan is at 4.5%, and you're getting a price that's 20%, maybe 25% lower than it was 2 years ago.
I'm a cash buyer. I can just, every time I think about loans,
Yeah,
every time I
exactly.
have heartburn, it's because there's a loan. I get it. People that know how to use leverage, you guys get a gold star. But either way, right? If you can get an assumable loan, and it's like, would they be 3%, 3.5%, or because it's 5 units and
Four,
above,
I think
you're in
four
the
is
higher?
more common than 3.5% with their multifamily loans. So that they tend not to be in the three. Single families are in the threes. So four is actually fairly common. But I would say the best leverage today is not rates or loans, but the best leverage today is time. So you notice that what I'm doing with land, I don't call it land banking, because to bank land, you have to pay for it. I call it land squatting. So anyone can do this at any level. Like, you can go and find a piece of land that you think you can build four single families on, and go land squat and keep making offers until you get 21 months. I promise you'll never end up building these. You're going to flip them, but you're not going to pay for them ever.
Because they're not getting permits right now, so they're sitting there. They're gonna have all these people because they're able to build 600,000 units. What are those people going to do?
Yeah, yeah,
Like right
exactly.
now, it's really
The
hard to
the
find the
construction
contractors.
industry has ramped up. Somebody is building 672,000 units delivering today, right? But
Yep,
next year, permits have already told me we're going to build 400,000. So these people are going to basically say, let's turn around and look for small pieces of land that we can build on. And you're going to be squatting on those pieces.
yep. You're going to have them all tied up. Fantastic, Neal. As always, I sit back and I always learn something, and I love the way you think. And for folks listening out there, if you're watching on YouTube, please like and subscribe, because Neal is on here at least a couple times a year, and he always brings the facts. I like it because you're data driven and you're not emotional about it. You're just like, here's the facts, and
It's all matter.
here's what we can do about it. So I really appreciate you.
Awesome. Well, thanks for having me back. It's always fun to talk with you, Toby.